Well, good afternoon, everybody, and thank you for joining us on our webinar for long service leave. My name is Angela Lehmann, and I am the Legislation Manager here at ADP. We expect that today's webinar will run for approximately 30 to 40 minutes. We have all attendees muted, but feel free, if you have any comments, if there's any issues with the webinar, please feel free to add a comment to the chat screen on the right of your screen. Unfortunately, due to the complexity of the topic and also to the sheer volume of attendees we have today, we will not be answering any questions during the session. Please hang on to the end, because we will be providing details on how you can get further information. Please note that today all we are doing is providing high-level summary of the topic, and it's not intended to be advice. So, as I said, we will point you in the right direction towards the end. That said, I would like to introduce everyone to David Bates. He's the Managing Director of Workforce Guardian, which is our HR partner. Hi, David.
Hi, Angela. How are you going?
Good, thank you. Thanks for joining us today.
My pleasure. Always happy to work with the team here at ADP and to provide what we think is some really practical and useful information for Australian employers about long service leave and as well about the tax implications of it.
Yeah, exactly. So as David's indicated, I'll add my 5 cents worth on the tax implications of the topic. But David, seeing as you're kicking us off, I'll let you take over from here.
Perfect. Thanks, Angela. I really appreciate it. So, first thing I'll do is just provide everyone with an overview of what we're going to cover off over the course of this 30 minutes or so. Effectively, we're going to begin by discussing the relationship between long service leave here in Queensland and the National Employment Standards, or the NES for short. And then what I'll do is I'll just mention the specific legislation that we do have here in Queensland which governs long service leave for most employees. We'll then drill down a little bit further and specifically talk about how long service leave actually exists in terms of the leave entitlement itself, how is it actually taken, and we'll talk about pay. What do you actually pay people when they take long service leave? We'll then touch on a topic which we get asked about all the time, which is what we call pro-rata long service leave, so the paying out of long service leave before an employee has completed 10 years of service. We'll then discuss the actual taking of long service leave itself before looking at some of the other rules which apply here in Queensland to long service leave, and really what we'll do there is cover off some of the most commonly asked questions about long service leave. Then I'm going to hand it back to you, Angela, to talk about the tax considerations, so the things that employers need to know both when people take long service leave or are having it paid out. And because we love leaving our listeners with some useful additional resources, we'll also finish off with some links for you about where you can go to get further information about Queensland's long service leave legislation, as well as obviously the tax implications as well.
Yeah, brilliant.
All right, so let's have a chat about the National Employment Standards and long service leave, because this is something that does still cause a little bit of confusion. Hopefully most people taking part in today's webinar would be aware that quite a few years ago now, Queensland transferred its workplace relations powers to the Commonwealth Government. And that's just a really technical way of saying that basically Queensland decided that it would become covered by the national employment laws. So when the Fair Work Act was introduced back in 2009, it included 10 national employment standards, and they took effect 6 months later on the 1st of January 2010. Now, Queensland then handed, if you like, its powers to the Commonwealth Government from workplace relations point of view, and so as a result, the Fair Work Act and the 10 national employment standards that are within it began applying to Queensland employers. They certainly apply to any private sector employer here in Queensland. There are some exceptions for state government funded bodies, councils, etc., but if you're running a private business, then you're almost certainly covered by the Fair Work Act. Now, one of those 10 national employment standards is long service leave. And the reason that it's included in the 10 NES is because the government's intention, although some would cynically call it a hope, was that they would develop one national long service leave entitlement. So we finally would end this crazy system, really, where every single state and territory has its own long service leave entitlement.
Kind of how we've harmonised payroll tax?
Exactly. Yeah. Harmonised payroll tax, harmonised workplace health and safety laws, harmonised quite a few things, but we've never gotten around, unfortunately, to harmonising long service leave entitlement. So as a result of, I suppose, that inaction over the last few years, even though long service leave is mentioned in the 10 national employment standards, from a practical point of view, we still need to go back almost 100% of the time to Queensland's own long service leave legislation. Now, it is important that every employer in Queensland correctly identifies the source of that particular long service leave entitlement for their employees. Now, for most employers here in Queensland, their employees are going to be covered by what's called the Industrial Relations Act from 1999, and it's within the Industrial Relations Act that we find Queensland's long service leave entitlements. Now, that said, there are, of course, some businesses that have what are called enterprise agreements in place. There can be some transitional and historical awards. There are some really tricky and convoluted, if you like, rules that might apply to long service leave. So if you are an employer who's not 100% sure that your employees are covered by the Queensland Industrial Relations Act from a long service leave point of view, then please do make sure that you get expert advice. Whatever you do, don't just assume that the long service leave entitlement is automatically coming from this legislation. And the reason that we don't want you to assume it is because there are, of course, heavy penalties if you don't meet your long service leave obligations, and you could have, apart from anything else, just unintentionally underpay or provide entitlements that don't meet the minimum legal requirements.
Yeah, I'm glad you've said that, David, because a lot of people just don't realise the severity of getting it wrong.
Absolutely, and it's one of those things where it's not a small thing to deal with. If someone reaches 10 years of employment and they want to take their long service leave, it's going to be a horrible shock to suddenly discover that all of your accruals for it are incorrect, or that you've massively underfunded your long service leave entitlement pool. So much better to know right now what your accruals or your obligations, liabilities really are.
Yeah.
So just again to clarify, we have the Federal Fair Work Act with these 10 national employment standards, but we still need to go back to the Queensland Industrial Relations Act for the long service leave entitlements in almost all cases. All right, so now that we've established that, let's have a look at what the leave entitlement actually is. Well, we don't like to do things easily. We don't like round numbers here in Queensland. So what we've got is that once an employee has reached 10 years service, they become entitled to 8.6667 weeks of long service leave. You don't want to miss that last 7, 8.6667 weeks after 10 years of service. Now, the reason that it sounds like an odd number is because, remember, long service leave used to be based on effectively 15 years of service. So when it was brought back to provide an entitlement at 10 years, the calculation was done and we end up with this odd number, but that's still what we have here in Queensland. And the entitlement doesn't just end once an employee has completed 10 years of service. That isn't the end of their long service leave accrual. In fact, for every subsequent 5 years of service, they then accrue the additional 4.3333 weeks, which brings it up, as you can see, if you do the maths backwards, I'm pretty sure what we end up with is, what would it be, 13 weeks after 15 years of service? Yeah, so I think that's how it was originally calculated and then worked back in this way.
Yeah.
All right, so now that you know, you've got 8.6667 weeks after 10 years service, 4.3333 weeks after each subsequent 5 years. The other important thing to know here is that casuals here in Queensland accrue long service leave. Now, this is one of the most common mistakes that employers make. They assume that casuals don't accrue long service leave, but in fact they do. And again, we've got a formula here in Queensland that actually tells you how to work it out. And that formula is shown there on the screen. To work out a casual's long service leave entitlement, we take the total number of hours they've ever worked in the business, divide it by 52, multiply that by 8.6667 divided by 10.
Yeah.
So yeah, nice. We love mathematical calculations, and because I do employment law and not tax, super, or salary sacrifice, I'll leave it up to your listeners or you, Angela, to do the calculations. In fact, just on that, looking back at my previous calculation of 8.6667 plus 4.3333, I think I got that wrong too. So don't.
We'll forgive you. We'll forgive you.
Yeah, please don't rely on me for maths. Just rely on me for the HR and employment law advice.
And I guess, David, for me, like kind of the outsider looking in on this one a little bit, but it's really interesting that for casuals in this instance, we're talking the life of their employment with that employer, right? So it's a long history you must have in your records to ensure that you can do the calculation correctly. Yeah,
that's a really good point actually, because and that goes to one of the other obligations that applies under the Fair Work Act, and that's the time and wages record obligation. So, for example, every employer that employs casuals here in Queensland must keep accurate time and wages records. So you can see how non-compliance with one aspect of the legislation then has a flow-through effect to all other parts of the legislation. So if you haven't kept the time and wages records, which the legislation expects and requires you to keep, then it's impossible for you to then calculate a casual employee's long service leave entitlement. So one, if you like, omission or failure to comply with the Act will inevitably result in many others. So compliance across the board is absolutely critical.
Absolutely.
All right, so now that we know that casuals accrue long service leave and we've got a calculation for it, and now that we know that I'm terrible at maths, let's move on and talk about what actually counts as continuous service, because you would have seen already that we talked about an employee having an entitlement to long service leave once they have completed 10 years of continuous service. So what would break continuity of service? What things could happen that would result in continuity of service being broken? Well, we know that service here in Queensland is not broken by any form of approved absence. So if someone applied to take 3 months of study leave, for example, unpaid study leave, and if that was approved by the employer, that would not break their continuity of service. We also know that if someone was dismissed due to an illness or an injury, and then they were subsequently re-employed by that same employer, that also does not break service here in Queensland. We also know that a dismissal and a re-employment within 3 months for any other reason, so if they're dismissed for any other reason and then taken back within 3 calendar months, that also will not break continuity of service. And finally, and we've written the letter A next to it, that obviously should be D, A, B, C, D. Yeah, apparently I'm not very good at writing English either, so my skill set seems to be declining by the second. But the dismissal, if it's due to slackness of work and then subsequent re-employment, that also won't break continuity of service. Now, the term slackness of work, I mean, that sounds a little bit archaic. Clearly, in modern parlance, what we'd be referring to there is a genuine redundancy.
Yeah.
So if someone was let go due to a downturn in the industry that the employer operates in and they have to let someone go, well, if they bring that person back down the track, then for all intents and purposes, their service has not been broken. So their, if you like, long service leave kicks back right from their very first day of employment. It doesn't get reset to 0.
Brilliant.
Now, what's really critical to note here is the difference between something breaking service and something counting towards service.
Yeah.
2 distinct concepts, and I think this is where a lot of employers do go wrong. So we know, for example, that if someone was to take approved unpaid leave, if we use that same example of 3 months study leave, for example, then we know that that doesn't break continuity of service. But importantly, that 3-month period doesn't count towards service.
Yep.
So in other words, when the employee comes back to work, they would need to do 3 months of employment to get back to the same point they were at in terms of their accumulation of service towards that 10 years to trigger their long service leave entitlement. So really important for employers to know what periods do not count towards service, because otherwise they might end up providing long service leave to employees before they are in fact legally entitled to it.
Yeah.
All right, so unpaid leave is the first of those. The second is any period between employment with the employer. So again, if the employee was, let's say, let go due to a redundancy and then re-employed 5 months later, that 5-month period doesn't break continuity of service, but it doesn't count towards the accumulation of service for the purposes of long service leave. All right. Now, one other point to note here in Queensland is that long service leave does continue to accrue while an employee is receiving workers' compensation payments. So if someone's absent for work, say for 6 months due to a work-related injury and they are receiving workers' comp, then that 6 months will contribute towards their service. So that is a question, again, that we get asked very regularly here at Workforce Guarding from ADP. So glad we can clarify that one for you. Now, the next logical question is, okay, so the person is now entitled to take long service leave. Well, what the heck do we pay them? What do they actually receive when they go on long service leave? Well, here in Queensland, as in most states, the definition of what has to be paid is what's called the ordinary rate of pay. And effectively, an employee's ordinary rate of pay is their base rate. It's the amount without things like shift loadings, allowances, penalties, these other amounts that would usually be added because of the particular time of the day that an employee works, or maybe the day of the week that they work. So we take those things out, and what we're left with is the employee's ordinary rate, and that's the rate that will kick in. Now, importantly, here in Queensland, if the employee happens to be being paid at a higher rate at the time when long service leave is taken, then that higher rate will remain payable. So if, for example, they've just had an increase and it's meant to be a temporary increase, but that's when they take long service leave, that higher rate will actually need to be carried through the entire period of long service leave. So need to find out the ordinary rate and then kick it in.
That's interesting, isn't it? So even if I've just got a temporary higher duties type role, I'll be paid at that rate?
Yeah, technically yes, if you were to take long service leave at that point. So yeah, pretty canny employee there, organising it. Yeah, strategic thinking, yeah, to set that one up. All right, now the next thing that we often get asked, and Angela, I know you get asked this all the time at ADP, right? So it's what we call pro-rata long service leave. Now I really want to be clear here and emphasise that what we're talking about is the pro-rata payout of long service leave. We're not talking here about people taking long service leave. We're talking about the circumstances when an employee is entitled to receive a payout of long service leave because their employment has ended. Now, here in Queensland, employees may become entitled to receive a payout of their long service leave if their employment has lasted for at least 7 years. So we're really talking here about between 7 and 10 years of service, because once you get to 10 years, it's guaranteed anyway. Yep. But if you've reached the 7-year mark and then your employment ends in any of the circumstances that we've shown on the screen, then and only then is pro-rata long service leave payable. So if the employee leaves their employment because of illness, incapacity, or what's called pressing or personal necessity, and that has, I have to say, a very, if you like, it sets a low bar. Employees are able to really, in most circumstances, argue anything as a pressing or personal necessity. So something that causes them a great deal of stress, maybe they're under some financial strain, someone in their family is sick, you know, they become a single parent. These are all clear examples, if you like, of pressing personal necessity. Or if the employee is dismissed unfairly, and clearly we go back to the Fair Work Act for the definition of unfair dismissal. So that's a dismissal which is harsh, unjust or unreasonable. So if that happens and the employee has completed 7 years of service, they receive a payout. And thirdly, if the employee is dismissed for any reason relating, or any reason I should say, other than conduct, capacity or performance. So again, if the employee was let go because of a redundancy, that would not be related to conduct, capacity or performance. So if they've completed 7 years of service at that time, they would then have an entitlement to a payout of their pro-rata long service leave. So one of those 3 key criteria must be met in addition to the employee having completed 7 years of service.
Now, I think that does get overlooked quite a bit, David.
It really does, and I'm not surprised that there's confusion around pro-rata long service leave, certainly because anyone who's joining this webinar that has employees in other states would know that the rules are different for this as they are for long service leave across the board, but specifically in relation to pro-rata long service leave, the rules differ quite dramatically from state to state and territory to territory.
Okay.
So, you know, you might be very familiar with how it works in, say, New South Wales, but it's a whole different kettle of fish here in Queensland. So it is really critical to know when and how pro-rata long service leave payouts are required. Now, here's the good news. In Queensland, we have one of the most flexible long service leave laws in relation to when long service leave and how long service leave is taken. So effectively in Queensland, unlike many other states, the employer and their employee are really completely free to agree when and how long service leave will be taken. So if they want to take 2 days and then take another week, then take a month, then take 2 days, no problem. So all of that can be agreed here in Queensland, of course, once the employee becomes entitled at the 10 years of service mark. So after that, the parties are then free to negotiate amongst themselves. Now, unfortunately, if you know, you have that circumstance where they can't reach agreement, well then the employer can direct their employee to take long service leave, but they do have to give them at least a 3 months heads up. So if I'm going to direct someone to take long service leave because we can't reach agreement and they've completed 10 years of service, I do need to give them at least 3 months notice. Now this is also subject to what are called industrial instruments, and that means awards or enterprise agreements, things like that. So they also always need to be consulted. And if I am going to direct someone to take long service leave, not only do I need to give them 3 months advance notice, but I also have to provide them with at least 4 weeks of their long service leave. So I can't direct someone just to take 1 week or a fortnight. I have to direct them to at least take one full 4-week block. And of course the idea behind that is to prevent people really being denied the benefit of long service leave where they can take a long extended period away from work to effectively recharge or refresh after a long period of service with their employer.
And realistically, it's a benefit to both the employee and the employer because the employee gets to, as we said, rest and recharge. But from an employer's perspective, they would want to eliminate some of that liability that they're carrying and be able to reduce that burden as well.
Yeah, really good point, because unlike, for example, personal carers leave, which is accruing from year to year, and unused personal carers leave is rolling over, long service leave is a liability that's sitting there on the bottom line, and if the employee does meet that 7-year trigger and then leaves in any of those circumstances we talked about, or indeed if they make it to 10 years, and I shouldn't say make it, it sounds a bit like, it's a hard slog, but 10 years is a long time. But if they do get to that 10-year mark, well, that is a liability that's sitting on your bottom line. So you do want to use it really and take it off as soon as you can, if possible. So yeah, definitely worth making a move on it.
Oh, David, my favourite topic.
Yeah, everyone loves this one. We're talking here about the other rules that also apply to long service leave, and the first of those is cashing in, or sometimes called cashing out, long service leave. And you're right, Angela, we get asked this all the time. Can my employee cash in or cash out some of their long service leave? And sometimes we're asked this question in relation to employees who have completed 7 or 10 year service. Other times it's just a random cash in or cash out scenario for long service leave. Here's the definitive answer. If the employee is covered by the Queensland Industrial Relations Act for long service leave purposes, then they cannot cash out long service leave unless one of those 2 specific requirements have been met. The first of those is that the cashing out is expressly permitted by an applicable industrial instrument. And by that, again, we're talking about an award or an enterprise agreement, some form of industrial instrument. To be very clear, a written agreement that an employer makes with their employee is not an industrial instrument. So just because the 2 parties agree amongst themselves to do it, that's not enough. That does not meet this criteria.
I'm so glad you've added that, because I have had that brought to me before that, well, it's fine because we have it in writing between the 2 parties, so it should be fine. So I'm glad you've covered off on that.
Yeah, no, that agreement completely unenforceable. It would be like me having a written agreement with my employer to not deduct income tax from my pay. It's nice that we can put that in writing. It's great that we agree to it, but it's completely unlawful and unenforceable. So a pure written agreement won't cut it. So in the absence of an industrial instrument that expressly allows cashing out, and remember again, silence in that document isn't enough either. So just because the industrial instrument doesn't say you cannot do it, it doesn't mean you can, all right? So the industrial instrument must be clear. The only other circumstance where you can cash out long service leave is if an application has specifically been made to the Queensland Industrial Relations Commission for authorisation for the cashing out to occur. Now usually it's the employee that would actually make that application. So they might speak to their employer, the employer might be happy to cash out some of their long service leave, but again, they cannot do it until one of those 2 people have made an application to the QIRC. If the employer supports the application, then there's rarely ever going to be a problem. The Commission would say, yep, go ahead and do it. And it's only when the Commission has made that ruling that you can then go ahead and do it. So in all other circumstances under this Act, you must not cash out a long service leave.
That's really interesting, isn't
it? It's interesting, and people don't pay attention to it, unfortunately, and it really does have significant consequences because there are penalties that apply regardless of whether the parties were happy to do it. So really important that we comply with the legislation there. Now here in Queensland, just so that you're also aware, there are 2 other additional rules that I want you to know about. There are specific rules that we have for seasonal employees, so people who are employed, for example, to fruit picking. So just because they have gaps in between their periods of employment, the legislation here in Queensland recognises that and allows them to continue accruing long service leave despite the breaks in their employment. And again, that really goes back to continuity of service. And like many other states, we also have special rules in place for workers in the construction industry who change employers all the time. So there's effectively a portable long service leave entitlement. And here in Queensland too, uniquely, well, it might exist in 1 or 2 other states, but we also have a specific regime for people working in the cleaning sector. So again, people who are changing employers quite frequently, there is a safety net for them as well so they don't miss out on long service leave.
So David, it really does tie back to, as you said before, knowing the NES and knowing your obligations as an employer, because again, it's knowing your industrial instrument, what applies to which employee, to get it right all the way through. It's a flow-on effect.
Absolutely, and if you're right, if you miss a part of it, it's like it's like a three-legged stool, right? If you take one of those legs out, the whole thing falls over, and that's exactly what it's like in employment law. If you're not compliant in one area, everything else is off kilter, and eventually it will catch up with you. So it is, really important that across the board there is compliance. All right, so now that we've covered off the Industrial Relations Act 1999, I'm going to hand over to you, Angela, to talk through tax considerations that apply, because this is, for all intents and purposes, just as vital for employers as the long service leave legislation itself.
Yeah, and it can be complex. It can be quite complex. However, it is federal, so it will apply across the board. So regardless of which state or territory you're employing an employee in, the same rules will apply across the board. So that is one key positive takeaway from this. So the first scenario I wanted to cover was long service leave paid to continuing employees, or in other terms, long service leave paid to employees taking long service leave. So as you would all be aware, we have the tax tables. There's a weekly, fortnightly and a monthly tax table that we would always use for processing payroll and determining withholding on our salary and wages. Well, the exact same tax tables are used when you are paying an employee taking long service leave. The only sort of quirk or scenario you need to be mindful of is where you're paying an employee long service leave for a period that's greater than one of your pay periods. So, for example, if you're a monthly payroll company and the employee is taking 3 months of leave, you need to be able to apply the formula you see on your screen. So as an example, you would work out what their monthly withholding amount is times by the period of the leave, so 3 months, and that gives you the overall withholding. Obviously, this step always comes after you've done the calculation and worked out the entitlement and how much should be paid to the employee. The other point to mention on taking or paying long service leave to an employee when they take it is that it actually meets the definition of ordinary times earnings, or OTE. So the 9.5 super guarantee charge, or super guarantee amount does apply. So please be mindful of that and meet that obligation as well.
Well, that's one of the questions that we do get asked all the time as well, is what amounts count as OTE and what amounts don't for a superannuation contribution point of view.
Yeah. And you know what, David? Sort of following on what we've been saying on our messaging from a HR and employment law perspective, the other thing is that what probably a lot of employers don't realise is the ATO and the government had some changes a few years ago where director penalty notices can actually be issued to directors of companies to be personally liable for withholding and super guarantee tax obligations that aren't met. So it really is important, and I guess, you know, it's not something to be scared of, but really aware of, is that they do take meeting your employees' tax obligations really seriously. So if you're not meeting your obligations, there are issues with, one, super guarantee has a charge, which is a penalty, and then also the director penalty notices where you could be personally liable as a director for meeting those obligations.
Well, I'm a director of Workforce Guardian, so thanks for alerting me to my director of obligations.
Do your research ASAP. Okay, so that was, our first scenario was quite simple, let's say. Our second scenario is slightly more complicated, but I feel that the ATO has done a great job in providing guidance on this. So long service leave when it's paid as unused lump sum on termination of the employment of the employee. So the ATO refers to it as Schedule 7. It's called the tax table for unused leave paid on termination. So really important that you refer to the right tax tables, not the normal withholding tables. The table actually splits the withholding rates between a normal termination, such as a voluntary resignation, employment terminated due to inefficiencies or retirement, versus genuine redundancies, invalidity or early retirement schemes. So there's two categories you have to be aware of there to know where to look for the right withholding rate. Then the second point to note is that the withholding rate is then further broken down and referenced to accrual date. So when I say accrual date, there are three main components of the accrual date. There is the component that's accrued pre-August 1978. Then there's the component that's accrued between August 1978 and August 1993. Then there's the component that's accrued post-August 1993. So it sounds a little bit tedious.
Yeah, it sounds a bit complex.
It does, but then the ATO has kindly included in that document which payment summary labels each of those components needs to be disclosed in. So that's very helpful. The key takeaway on paying long service leave to a terminated employee is where it's actually to a deceased employee or a deceased employee's estate, there is no withholding obligation. So please do not withhold in any shape, way or form. It's very important that you're aware of that. The other note I'll give is that this scenario here where we pay long service leave on termination is actually specifically excluded from the definition of OTE, and therefore SG does not apply. So where it does when our employee takes leave, it doesn't apply when they are terminating and have the leave paid out.
Wow, this is why I don't do tax.
And why I will not touch employment law.
Snap.
So I guess the last, and not highly likely, but you know, for good measure we always throw things in, is back paying long service leave. So generally this would only really apply when you have underpaid an employee or made some kind of error or omission in a previous pay period. So it isn't going to be too common, but the relevant schedule for that kind of payment is Schedule 5 for unused back payments. There is a quirk on this in that there is a total withholding limit of 49% of the tax withheld, and this limit is also influenced by if you are paying to an employee who has HECS or HELP, trade support loan or financial supplement debt. That limit can be influenced by that type of employee as well. So please be very mindful. There is explanation in the Schedule 5 commentary to help you work out what is appropriate. There are two calculation methods or withholding calculation methods available on Schedule 5. We have Method A and Method B. You're laughing, aren't you? Method A is quite straightforward, and it's suitable for regardless of whether the back payment is in the current financial year or previous financial year. You can use that method. And then Method B has two parts. Part B1 is for back payments that apply to specific periods in the current financial year, whereas B2 can relate to prior financial years or any time. So believe it or not, the choice is yours. You can, I mean, obviously if it's in a previous financial year and there are specific methods that only look at that, that's fine, but the choice is yours. And that schedule is brilliant because it does give you a step-by-step calculation work paper, basically, that gets you to the correct withholding answer. So it's brilliant. It's as exciting as tax gets.
You did say something about taxes. Brilliant.
Yeah.
Okay, all right.
I will have full disclosure, I am a tax nerd, so I do apologise to all of you rolling your eyes right now. So, seeing as we did promise to be as useful and provide as many tools as possible, we have our useful resources slide here. David has kindly given us a really good link to Queensland's sort of industrial relations type information.
Yep, absolutely.
And then I have given you the link to both Schedule 7 and Schedule 5 to do that riveting tax reading that I promised. Please don't write to me if you don't find it riveting.
Put down your copies of 50 Shades of Grey because here comes tax schedule 5 and 7.
Thank you, David. Sarcasm duly noted. But speaking of helpful resources, David.
Absolutely. So we've got everything you need. If you haven't already been convinced by this webinar just how complex some of these areas can be, well, the good news is that here at ADP and at Workforce Guardian, we've got all the solutions and services you need. So if you're not already an ADP client, do talk to the team. Call them on 1-800-000-729 and have a chat about ADP's range of payroll solutions. They really do have a solution for every type of business. And if you are already an ADP client, here's some even better news. Once you become an ADP client, or if you are an ADP client, you'll then have access to the dedicated workplace advice line. And that workplace advice line is powered by our team here at Workforce Guardian. And in addition to that, there are a whole range of subscription services that you can access via ADP into Workforce Guardian, which will enable you to not just have all of your payroll covered with ADP, but all of your HR requirements met by Workforce Guardian from ADP.
It really does go hand in hand, David.
It does. You can't separate payroll and HR in this country. So by having this partnership in place, you've got everything you need. So please do get in touch with the team.
Thanks, David. Thank you for joining us.
My pleasure. Thanks for having me along.
Okay, and thank you to all of you listening. We really hope this presentation's armed you with some key knowledge and some tools, and we look forward to speaking to you again soon.
Thanks, everyone. Bye for now.